Hello there. I want to welcome you once again to my YouTube channel. Thank you so much. I appreciate your support so far. Thank you. I really do appreciate it. To continue from our last week discussion, last week we dealt with IAS 2 accounting for inventories, and today we are going to continue with our asset standards, and we'll be looking at IAS 610, property, plant, and equipment. So our lesson objectives today is to identify and define key terminologies, to identify cost components to capitalize as part of the cost of the assets, and then to demonstrate how to apply the various concepts under PPE. By definition, PPE are tangible assets held by the business for use in production or the supply of goods and services, for rental to others, or for administrative purpose. They are expected to provide economic benefits beyond 1 year period. For example, MTK is a car manufacturing company selling cars. The entity had the following at the end of the reporting period, 31st December 2023. So we identify motor vehicle to be $100,000, administrative building to be worth $200,000, manufacturing building to be worth $150,000, engine oil for sale to be worth $20,000. For us to differentiate between what we classify as inventory and then what we classify as PPE, we first of all have to understand the core business of the entity. So all the items apart from engine oil listed here, they can all provide economic benefits beyond 1 year. But then we have to ask ourselves which of them should we classify under PPE, depending on the core business of MTK. So MTK deals in the sale of cars. So motor vehicle among the list will have to be classified as inventory because it deals in cars, it sells cars. So if it had a private vehicle that it uses for its operations, probably we would have considered that as PPE. But for this question, motor vehicle here will be classified as an inventory. So among the list given to us, it was two of the items that qualified for our classification of inventory: the administrative building of $200,000 and the manufacturing building of $150,000. So that gave us a total of $350,000. So there are key terminologies that I want us to be comfortable with. As we go along, we will be coming across these terms. So I want us to be okay with it as we progress with the lesson. Cost. It is the amount of cash or cash equivalent paid or the fair value of the other consideration given to acquire an asset at the time of its acquisition or construction, or where applicable, the amount attributed to that asset when initially recognized in accordance with the specific requirements of other IFRSs. So what we are saying is that apart from cash that we paid to acquire an item or an asset, we can also consider the fair value of an exchange, such as share exchange. For instance, if I want to acquire a building and then I don't want to use cash in acquiring that building, and I decide to use share exchange in the acquisition of the building, that can be other form of consideration used for the purchase of the building. So what we are meant to understand is that the fair value of the shares that I have used in the exchange should be classified as the cost of the building at the time of acquisition. Fair value. It is the amount for which an asset could be exchanged between knowledgeable willing parties in an arm's length transactions. So knowledgeable should be people of sound mind, people who have an idea of the transactions, people who know actually what they are doing, both the buyer and the seller. And then parties who are willing to let go of what they have. The one who have the asset should be willing to let go, and the one who have the cash should be willing to pay for the asset. And this transaction should take place at an arm's length transaction, meaning that the two parties should not be in any form of related party relationship. So the transaction should not be of a related party transaction, meaning that what a third party who have bought the item should be that which, if I'm the one purchasing the item, I should pay for the item. That's what we mean by an arm's length transaction. Recoverable amount. It is that part of the net carrying amount of an asset that the enterprise can recover from the future use of the asset, including its net realizable value on disposal. It is a higher of the asset's fair value less cost to sell and its value in use. So over here, you have to compare the net realizable value. And then the net realizable value, it is a fair value of the asset, how much we are willing to sell the assets, and then any costs or incidental costs that we may have incurred as a result of the sale. So when we deduct the incidental costs, the amount that we will be left with is a net realizable value. And we have to compare that value to the value that we will get as a result of using the assets. So we will use the present value of the amount. So whichever is higher, then that will be considered as our recoverable amount. Now, the carrying amount. It is the amount at which the asset is recognized after deducting accumulated depreciation and impairment where applicable. So, some books will refer to carrying amount as carrying value. Some too will refer to it as a net book value. So whichever term that you come into contact with, know very well they are all being referred to the same thing. So in this instance, so the value that you see in the books, the financial statement of an asset, that is the carrying amount or the carrying value, the value at which it is being recognized after we have deducted our accumulated depreciation. Accumulated depreciation, these are depreciation from the time that the asset was available for use till the accounting period under consideration. And then any impairment losses also follow the same thing. So we will get to understand what an impairment loss is going forward. Depreciable amount. It is the cost of the asset less its residual value. So then what is a residual value? A residual value, it is an estimated amount that the entity or an entity would currently obtain from disposal of the asset after deducting the estimated cost of disposal if the asset were already of the age and be in the condition expected at the end of its useful life. So what we are saying is that you estimate how much or how many years the asset is expected to be useful to us. How many years are we expected to use the asset? That is the useful life of the asset. During that time, how much are we able to sell the remainder of the asset? What is left of the asset? That value minus any cost that we may have incurred in disposing of the asset at that point in time. That will be considered as our residual value. Depreciation, it is a systematic allocation of the depreciable amount of an asset over its useful life. And then we have already defined what a depreciable amount is. We said that it is the cost less any accumulated depreciation or accumulated losses. Now, accumulated impairment, So an impairment loss, it is the amount by which the carrying amount of an asset exceeds its recoverable amount. We have defined what a recoverable amount is. For a quick recap, we said that it is the higher of the net realizable value and the value in use. We've already defined what a carrying amount is. We said it's the amount at which the asset is recognized after deducting any accumulated depreciation and accumulated impairments. So when we compare the two figures, and if we realize that the book value or the carrying amount of the asset is more than its recoverable value or amount, then we can say that that asset has been impaired. Recognition criteria. We should note that PPE can qualify for recognition if it meets two sets of criteria. One, it should be probable that future economic benefit associated with that asset will flow to the entity, and also the cost of the assets can be measured reliably. You see, in our earlier definition or our earlier classification of what an asset is, if you can remember our initial example that we did, we spoke about motor vehicle, and then the business was dealing in the sale of cars. So we considered the motor vehicle in our illustration as part of an inventory, not an asset, not PPE, pardon me. So let's go over the first set of criteria again. It says that it should be probable that future economic benefits associated with the asset will flow to the entity. So after today, after a year going to the future, it should be certain, it should be ascertained, it should be possible that it will still contribute towards the profit making of the organization. It should contribute to producing profit to the business. So if the item meets these two criteria and the cost can be measured reliably, then it can qualify for recognition as property, plant, and equipment. Initial measurement. PPE is initially measured at cost once it meets the recognition criteria which we've already identified. So cost components. So there are some components that have to be factored into our costs, and then there are some components too that has to be excluded, and the reasons has been identified in the below. So purchase price less any trade discount or rebates. So if we go and then purchase an item and we are giving any form of discount, we have to ensure that we take out those discounts or these discounts. And then if there any rebate that has been given to us as a result of the purchase, we have to take it off. So the net figure is what we will consider as part of our cost component. And in the process, if we incurred any input duty as a result of input or any tax that is not going to be refunded to us, it's something that we have paid and then we are not going to claim it back, then we have to factor in these components as part of our costs. Also, any direct attributable costs of bringing the asset to its current working condition for its intended use. Example, cost of site preparation, installation, and assembly costs, initial delivery and handling costs, cost of testing whether the asset is functioning properly after deducting the net proceeds from selling any item produced while bringing the assets to that location in condition, such as sample produced when testing equipment. The last point is trying to highlight that if there is a need for testing of the machine, for instance, we would have incurred some cost in testing. Probably we have engaged the services of professionals who knows how to operate the machine. So if we are able to come up with a sample, for instance, if we are into the production of juice and then we've purchased the machine for that, and as part of the processes of testing, we decided that, okay, let us produce some juice and sell and see how the customers will react. So when we produce the juice and we sell, any money that is being realized from the sale should be subtracted from the testing cost or the cost incurred in testing, and the net figure should be added to our cost components. Also, any cost incurred in hiring of a professional or in respect of a professional fees, that will also have to be included in ascertaining our costs. We've dealt with the initial measurement. Now, we will look at the subsequent measurements. So with subsequent measurement, we have an option to either adopt the cost model or to adapt the revaluation model. So with the cost model, what we will do is that we will less our depreciation, accumulated depreciation and impairment loss from the cost of the item. And then the revaluation model, assets are carried at a revalue amount, being its fair value at the date of revaluation, less any subsequent accumulated depreciation and subsequent accumulated impairment losses. We've already defined what a fair value is. We've already defined what depreciation is. We've already defined what an impairment loss is. So now we have a fair idea of what the terms mean. That was the reason why we have to ensure that we define or redefine the terms. So when we decide to adopt the revaluation model, we should consider the following. The market value of land and building usually represent the fair value, assuming use and line of business. Such valuations are usually carried out by professional qualified valuers. II. In the case of plant and equipment, fair value can be taken as market value where a market value is not available. However, depreciated replacement costs should be used. The frequency of valuation depends on the volatility of the fair values of individual items of PPE. The more volatile the fair value, the more frequently revaluation should be carried out. So, when we talk about volatility, we are referring to the rate of change. So, if you see that the value of a particular asset is such that it changes so frequently due to certain conditions. It can be economic conditions, it can be as a result of demand. Probably when demand go high, the value of that item may have increased or anything. There are factors that may have influence or that could have an impact on the volatility nature of the fair value. So if you see that the value of the assets keep changing, so this will require a frequent revaluation so that we will be able to ascertain what the value of that particular asset is at every point in time. So if the fair value of the assets is such that it's really volatile, then that means that we will have to engage in frequent revaluation processes. IV. All items within a class should be revalued at the same time. So if items are formed within a particular set of class, you should make sure that they are being revalued at the same time. And the reason is to prevent selective revaluation of certain assets and to avoid disclosing a mixture of cost and value from different dates in the financial statement. So obviously when we involve in or we are engaged in revaluation done 2 years ago will be different from another done this year. So when we do that, you will see that there are differences in the figures. So how do we treat those differences? So this section of the lecture will help us to understand and then to know how to treat differences as a result of revaluation. Where there are increase in the value of an asset due to revaluation, the difference should be credited to equity under the revaluation reserve or capital surplus. So when we've done a revaluation and then we realize that there's a gain on that revaluation, those gain doesn't go into P&L. It has to be classified under reserves, revaluation reserves, and then or a capital surplus. So that item is being classified under equity or is being credited to equity with the amount or the value of the gain. However, the increase shall be recognized in the profit and loss account to the extent that each revaluation decrease of the same asset previously recognized in the profit and loss. So if you have previously revalued the asset and then you recognize a loss, normally we do not record losses in revaluation reserves account. So those losses will have to reflect in our P&L account. So at another period, if we are able to realize a gain on revaluation, we will now go to the P&L account and then reverse the impact of the initial loss on revaluation in the P&L. That's what this point is making us to understand. And then when an asset's carrying amount is decreased as a result of revaluation, the decrease shall be recognized in profit and loss, which we've already said. However, the decrease shall be debited directly under the heading of the revaluation reserve or capital surplus to the extent of any credit balance existing in the revaluation reserve or capital surplus in respect of that asset. So what this point is trying to say is that if for a particular year we have recognized a loss, ideally we should have taken the loss into P&L. But where there are credit balances in our reserves accounts, we will have to go and then recognize the loss in the reserve to the extent of the loss. If, for instance, the total loss is $5,000, we should recognize the $5,000 in our reserves account to reduce the total amount that we have in our reserves. So let's note this. The revaluation surplus included in equity in respect of PPE may be transferred directly to retained earnings or income surplus when the asset is derecognized. When we talk about derecognition, we are just trying to say that we are taking the asset off our books. So when we sell the asset, for instance, we have derecognized the asset from our, which means we no longer own the asset anymore. We have sold it. We have realized gain on the asset. So if that happened, the gains that we realize as a result of revalue, we have been realized. So that amount should be classified under, or it should be added to our retained earning, transferred from the revaluation surplus account to our retained earning or our income surplus account. And our retained earnings, these are earnings retained by the business after meeting all of its financial obligations to shareholders and to its to its creditors, or to its liability holders. So after it has met all of these obligations, then whatever is retained by the business, that's what we call a retained earning. And businesses use retained earning, as a form of a source of capital for undertaking it and growth. If the business wants to grow organically, it can decide to fall on its retained earning or their income surpluses, or if you want to undertake another project, or you want to acquire another business or something. So it can easily rely on retained earning, which doesn't come at any cost at all, or it doesn't incur any form of interest payment or what of you. So transfer of excess depreciation, that is a matter of policy. Some of the surplus may be transferred as the asset is used by the entity. In such case, the amount of the surplus transferred will be the difference between the depreciation based on revalue carrying amount of the asset and the depreciation based on the asset's original cost. So we are going to illustrate an example for us to appreciate the various concepts that we have talked about, the terms that we have used, how they actually come into play. So MTK Limited revalued its building and decided to incorporate the revaluation into the books of accounts. The following is relevant. Extract from the balance sheet at 31st December 2017. Our building cost 6,000 million. Depreciation, accumulated depreciation is 1,800. Our depreciation has been provided at 2% per annum on a straight line basis. The building were revalued on 30th June 2018 at 5,520 million. There is no change in the remaining estimated future life. Required, show the relevant extract from 2018 financial statement. I want to draw our attention for something, to something. We say that there is no change in its remaining estimated useful life. This should draw our attention that there are times when the useful life of the asset can be revised. Okay, so where there is an improvement on the asset, it increases a lifespan. So when that happens, then the life of the asset is being revised. But for this question, there were no changes to the estimated future life of the asset. Let's take note of this. Okay, and then let's also take note of the figures. For our workings, or before we can demonstrate or post the figures to our P&L and then our statement of financial position, let's go through the working so that you will know where the figures came from and all that. So if you can record just now, 30th June 2018, the company decided to revalue its assets, which is the building. So prior to 30th June 2018, the company had adopted the cost model of depreciation, the cost model. Okay, it had adopted that. So, and then we are supposed to carry out depreciation every year, meaning that in the year 2018, we will depreciate the assets under the cost model, and then we will also depreciate the assets under the revaluation model to complete the 1 year period. Remember, our accounting or reporting year is 31st December, right? So, and in calculating the depreciation after revaluation has incurred, it is the revalue amount over the remaining useful life of the asset. But in the question, we've not been given the useful life of the asset, but we've been given the percentage of depreciation, which is 2% annually on a straight line basis. So in order for us to estimate our total useful life, there are 3 approaches. So I have demonstrated the 3 approaches. So whichever work for you, then you are free to adopt. They all give the exact answer. So since our rate of depreciation is 2%, we will divide 100% by 2%, and that will give us 50 years. Or you can divide the cost of the asset by the annual depreciation. Depreciation is 2% annually, so 2% times 6,000, that will give us 120. And when we divide 6,000 by 120, we are going to get 50 years. Another approach is using the depreciation formula and then to find the missing item in the formula. We know that depreciation is giving us cost minus our residual value. Sometimes you may not see residual value, you may see scrap value or realizable value. Okay, so it is cost minus residual value over the useful life of the assets. Our depreciation has been given to us as 2% times 6,000. So when you do that, you get 120, which is equal to the 6,000. And in the question, we've not been given any residual value, so the value will be 0. Now, we do not know what the useful life is. We do cross multiplication. It will be 120 by the useful life equal to 6,000. We'll make useful life the subject, and to do that, we have to divide both sides by 120. When we do that, we will have 50 years. So whichever approach that you wish to employ, you will still arrive at the same answer. So now that we have gotten our total estimated useful life, to get our mini useful life, we will have to know how much of the years have you consumed so far. To ascertain that, we will divide our accumulated depreciation at the beginning of the year, which was given to us as 1,800, divided by the annual depreciation, the 2% by the 6,000, which is 120. When you do that, it will give you 15 years, meaning that before 2018, we had already consumed 15 years of the asset's life. So the remaining half period, when we use the cost model, January up to 30th June, we have to add that half year to it. So it is 6/12, which will give us 0.5. When we add that to the 15 years, we will get 15.5 years or 15.5 years. So when we subtract that from the 50 years, our remaining useful life will give us 34.5 years. Once we've been able to ascertain what our remaining useful life is, we can comfortably continue to calculate our depreciation expense. So under the cost model, from 1st January to 30th June, we use a cost model. So it is a 2% on a straight line basis actually. It is a 2% by the 6,000, which would give us 120. And then we have to multiply by 6/12 because we use the cost model for half period in the year. So when we do that, we will arrive at 60. And then using the revaluation model, remember I told you that depreciation under revaluation, it is a revalue amount over the remaining useful life of the asset. That made us to initially calculate for the remaining useful life. So remember, whenever there is a revaluation given in the question, try your best as much as possible to first of all calculate for the remaining useful life to make your work simpler. But note that the revaluation model was employed or deployed within the second half of the year. So we have to multiply by 6/12 as well. And that will give us 80. So the total depreciation expense for the period is 140 when you add the two. So we are done. The moment revaluation has been mentioned in the question, you should have this at the back of your mind that then there's a gain or a loss on revaluation. So let me go on and calculate for what that gain or the losses. And before we can ascertain what our revaluation gain or losses, we will first of all have to calculate what our carrying amount is. Remember, we have already defined what carrying amount is. So we'll just plug in the figures. Our cost is 6,000. Our accumulated depreciation or balance brought forward is 1,800. And then under the cost model, our depreciation for the period referred to working 2. It is 60. So how we got the 60 has already been explained. So when you add the 60 to the 1,800, we will arrive at 1,860. When we do the subtraction, we will arrive at 4,140. So this is the carrying amount of the asset under the cost model as at the date of revaluation. So when we compare the two, there's an excess of 1,380. And because it is a positive figure, it will be classified as a revaluation gain. If it was a negative figure, it would have been classified as a revaluation loss, which means that the carrying amount would have been greater than the revalued amount. So now we can comfortably continue to post our figures into our financial statements. We will first of all begin with the statement of comprehensive income for the year ended 31st December 2018. It's an extract. So depreciation, the 140, we've seen where it comes from. We calculated the first half of the year using the cost model and the second half of the year using the revaluation model. So the cost model gave us 60 and the revaluation model gave us 80. When we summed them up, we had 140. Other comprehensive income, we just saw that the revaluation gain on the asset at the period of revaluation was 1,380. So that was how we got these figures. MTK Limited, the statement of financial position has at 31st December 2018. If you can recall from our earlier submission, we said that subsequent measurements, when we decide to employ the revaluation model, it will be the revalue, the carry amount will be the revalue amount less any subsequent depreciation or impairment losses. So in this question, we do not have impairment loss, so we have depreciation. So subsequent, so after the revaluation, the depreciation that we incur was the 80, if you remember. It was the 5520 over the remaining useful life multiplied by the remaining half of the year. So that gave us a 80. So when we subtract, we will be left with 5,440 as the carrying amount of the asset at the end of the year. And then the Revaluation reserve, or the gain that we had. Remember, we said initially in our earlier submission that any gain on revaluation will be classified under equity under the heading revaluation reserve or capital surplus, if you can recall. So that's how come the 1,380 has been classified here. So that will bring out the end of today's submission or today's lectures. And this lecture covers IAS 16A. So I decided to treat the lecture or the IAS 16 standard into two folds, A and B, because of the detail of the standard. The standard is so broad. So I want us to be able to touch on all the principles surrounding IAS 16 so that if you are being tricked in any way or any form, you will be able to reproduce. So for that reason, we have decided to divide this section into A and B. Thank you so much. I want to appreciate you for your time and your efforts and every resource that you have invested in watching the video. If you have any question, kindly put it in the comment section, and then I'll do my best as much as possible to attend to it. And kindly remember to like the video, share and subscribe. Thank you so much. If you have any comments concerning this presentation, and if there is something that you didn't truly understand, please feel free to ask your question. And if you have any concern concerning the presentation, kindly feel free to give your comments. Thank you so much and have a good day.